Welcome back, everyone. The Naira has been appreciating against the dollar in recent times and has sparked some level of hope in the hearts of businesses and confidence in the Yemi Cardoso-led CBN. But for many Nigerians, all they're asking is, when will the impact of the appreciation of the Naira against the dollar have an impact on the cost of food items as well? Well, to help us make sense of it all, I am now being joined by an economist, Kelvin Emmanuel. He joins us from Abuja studio, and Dr. Naimeka Mira, the President and Executive Program Director, the Public Policy Advocacy and Research Council. He joins virtually from the United States. Gentlemen, good to have both of you.
Thank you. Thank you so much. Good to be here.
Let's begin with you, Emmanuel. In the past 3 to 5 weeks, we've seen the Naira appreciate now by about 30%, and that's from 1,915 all the way to even about 1,000 Naira. For some, is 1,050 Naira. Depends on where you're changing your money from, dollar from. But can you tell us specifically what is responsible for this?
Well, I'm not surprised that the Naira has been appreciating, and this is because if you notice very well in the last 3 months, the Monetary Policy Committee, since the President decided to do the needful to, follow the CBN Act of 2007 to raise the quorum to at least 6 members of the MPC, and then the MPC convened, and they actually swung into action to raise the MPR by 600 basis points or 6%. In order to tighten monetary policy and reduce what they call the yield curve differential. You've had that migration from Naira to dollar-denominated assets as inflation has risen. It slowed down. And you can see that there's been flows of monies into Nigeria by foreign portfolio investors with yields anywhere around between 23 and 26%. So that liquidity has helped the central bank to be able to sort out the outstanding forwards on commercial letters of credit, on Form A, on dividend and capital remittances. The CBN has said that IATA members who are the international airlines have been sorted for the valid claims. Notice very well that the central bank said they engaged a forensic auditor, an external auditor, Deloitte, to audit the $6.8 billion in outstanding forwards, and they found that 2.4 billion of it were actually invalid because they were not backed by any documentation at the time that the request was made at the central bank. So you can see a confluence of factors like the circulars on net open positions for longs that banks are not allowed to take, and then critically, the fact that the Office of National Security Advisor, along with the task force that was set up by the NSA, swung into action to remove the impact of P2P trading on Naira futures for crypto, and how that has played into the fact that the manipulation of the exchange rate has stopped. So all of these factors, the net open position for banks, which was a critical factor because quite a number of Tier 1 banks had about $5 billion net long, and the new circular says they're not allowed to keep any amount of money net long as net open positions, and they are obligated to shore up their deposits in terms of the clean lines they maintain with correspondent banks to settle swaps and forwards that they owe for transactions. So all of the impact of these very structural changes, and also very importantly, even if it doesn't look like it's a direct impact, if you notice very well, the circular, which we've been expecting since last year, Q4 of last year, where the central bank has asked the banks to recapitalize the minimum deposit capital to be able to revise their, capital adequacy ratio. And the central bank has said, very importantly, that they are not allowed to use retained earnings or additional Tier 1, AT1, as a means to recapitalize, has kind of created a new level of confidence in terms of foreign investors, because the Naira devaluation and depreciation actually impacted on the valuation of the Nigerian banks. So, for example, if you had 50 billion Naira for Tier 1 in terms of your minimum deposit capital, at 1,009, for example, that's dropped very terribly, to levels that were not seen anywhere around maybe $30 million. So if you notice that Tier 1 banks are now asked to raise by about 10 times, and Tier 2, they are asked to raise about 10 times. It's created a new level of confidence by foreign portfolio investors to bring capital into the Nigerian markets. But I think that going forward, this appreciation of the Naira, 45% appreciation of the Naira, is going to be sustainable if the Central Bank of Nigeria is able to collaborate with the fiscal authorities, to make some structural changes, which I'm sure we're going to discuss as time goes on, so that they can, go up from this strategy where there's an over-reliance on the central bank to be able to raise interest rates. Inflation has gone up to 30.2% again. The next MPC meeting, they might decide.
For cutting in. We'll speak more on that in just a moment. But I just want to bring Dr. Naira into the conversation as well, because some have said that, look, this is historic, and this has not happened we've not seen this kind of gains in a short period of time ever in the history of the country. What is responsible for the rate at which the Naira is gaining momentum against the dollar?
Having me. I'll talk about this in terms of policy issues. And one of the most important ones, I think, is getting rid of Binance. As you know, Binance is the vehicle that used to trade in currency. Very recently, I think Binance Nigeria lost, or rather, we have over $27 billion that left the economy. So by clamping down on Binance, we are saving, number one. Number two, I also think that moves that the government has made in terms of getting the NNPC to transfer their receipts directly to the central bank, that has also resulted in increased savings in terms of dollar. I think, like Emmanuel said, payment of backlogs, backlog forex by the CBN also help. And also equally important is the revocation, the recent revocation of over 4,000 Bureau de Change licenses. As you well know, these Bureau de Change people are the ones that are mostly responsible for the irresponsible speculations that go on in Nigeria that makes the dollar seem like the almighty dollar. And lastly, I think that the recent increase in oil production, I think we were somewhere around 1 million, and now we're about 1.5 million. That also is helping to increase our foreign exchange. And I think as we go forward, we can also talk about the what's the word I'm looking for? The signal that this present administration is giving that we should stop dollarizing our economy.
And Dr. Naira,
I think those.
Right,
yes,
sorry,
yes,
I'm staying with you, actually. I was going to ask you, whilst it seems as though the gains made so far is worth celebrating, do you think that the CBN have actually addressed the fundamentals of exchange rates?
Absolutely. Absolutely. It goes without saying. And I pray that that they continue with this vigor and rigor in the policies that they've instituted so far. I really do applaud the current government and the policies that they've instituted. For the first time, we're actually seeing the dollar being lower in the parallel market than in the official market. So that is very laudable.
Let me bring Mr. Emmanuel into the conversation as well. How sustainable are these policies? Because again, I asked Dr. Naira if he thinks that the CBN has addressed the fundamentals of the exchange rate. He said absolutely. But how sustainable are some of the measures that the CBN has put in place?
Look, Precious, I think there's an over-reliance on the Central Bank of Nigeria, and I've always said this. Even if I am quite impressed with Dr. Yemi Cardozo so far and what he's done with structural changes within the Central Bank of Nigeria, and particularly the fact that it shut down development finance completely, that had impairments of anywhere around 9 trillion naira, and is trying to unwind that from the balance sheet of the central bank, which would take him a lot. Look, I'm more concerned about the structural side and the buffers for the fiscal authorities. And I'll tell you what, two major things drive inflation, and inflation drives the migration of liquidity from naira denominated to foreign currency assets. As inflation goes up and that yield curve differential spread widens, you see a migration of flows. People are moving from naira assets to dollar denominated assets to protect their money, and that causes devaluation and depreciation of the naira. So for us to fight inflation, which is a key driver of the exchange rate, we have to go back to the fundamentals. And what are the fundamentals? You look at the power sector, for example, and the fact that a lot of power generation and use today is off-grid. Diesel is down to 1,000 thanks to Dangote refinery, but I will expect that the government will prioritize supplying him feedstock so that it doesn't have to rely on landing crude oil feedstock in Nigeria, which incurs about 28% landing costs. If you look at the fact that today on the balance sheet of 9 banks, 25 generation and distribution companies actually owe 1.49 trillion naira to the banks, and the Nigerian electricity supply industry is bogged down by debt, by impairment from collections, and you can see the level of power generation which affects businesses and which comes back to inflation, because when they go to have to use diesel and diesel prices are high, they price it into the cost of their goods and services. Then you come to the side of food, which is a major driver of inflation in Nigeria. Food inflation is 40%, which is unprecedented. We've never had 40% food inflation in the history of Nigeria. You look at the fact that we only do wet season farming. We don't do dry season farming because there are no developed irrigation clusters around Nigeria, especially in the north. You look at the fact that 70% of the component for blending fertilizer in Nigeria, ammonium nitrate gas, which gas prices were raised to $2.42 recently by NMDPRA, muriate of potash and phosphates. Phosphates and potash are actually imported into Nigeria. At what exchange rate? You look at hybrid seeds, you look at the cost of land opening and mechanization in Nigeria. These are the real drivers of food inflation, especially for primary production. And then on the other side, the ones that are imported in terms of enterprise goods or durable goods are impacted by the USD exchange rate and what they call transfer pricing. That's why, for example, you're not seeing prices come down, because there's transfer pricing. The stock of goods you have in Nigeria that are imported at a price that is higher than the current exchange rate. And it's going to take a while for you to adjust that price. So if you want to, ensure that there's sustainability, you have to focus on, amending, restructuring NNPC. And, I've said this before on this program that NNPC has issues. NNPC is supposed to be the cash cow. Nigeria is not supposed to have revenue challenges. You have to focus on increasing the amount of crude oil production, but reducing the unit production cost per barrel, which is currently the highest in the world at $48.71 per barrel. You have to focus on ensuring that the amount of encumbrances in fossil agreements are lower than 500,000 barrels per day in the production sharing contract and joint oil agreements that NNPC has. You have to give NNPC to an asset manager, the Ministry of Finance Incorporated, to manage, to optimize it. You have to, raise capital for NNPC to be able to do capital investments in floating LNG, export gas pipes, in doing like JVs with companies that want to build fertilizer blending companies or power generation companies or refineries, so that they can bring in income that the government needs to fund its budget, so that the government can rely less on debt, which has an impact on inflation and the exchange rate. So for me, these are the drivers that we have to focus on the long term, medium to long term, if we're going to have sustainability of the appreciation in the exchange rate.
All right, sorry again, I tried to come in because I want to again share the conversation with Dr. Mera. Dr. Mera, do you agree with Mr. Emmanuel that, look, there are loopholes. It is not yet Uhuru. We cannot heave a sigh of relief at this moment. There are loopholes. Some of those loopholes have to do with the fiscal side.
Yes, I agree with Mr. Emmanuel. And in addition to, for instance, just like he mentioned, I think the current consumer price index is at 32%, 32.2 or something like that. And that is up from 31.7% in February. In March, it's at 32.2%. But I assume 33.2%. I think what we also have to think about will be to sustain this strength that we're seeing in the Naira, and also to control inflation. Some of the things that the government is doing are already beginning to seem to work. For instance, the price of some of these commodities are beginning to come down. I know the inflation rate is still at 40%, but if you look at the northern part of the country, you see that prices of like maize and rice and so on are beginning to come down. The reason this is because of the strength the Naira is gaining now. So we are beginning to see reversal of trade, so to speak. You are beginning to see goods now coming into the country, as opposed to, say, 6 weeks ago, 2 months ago, when the Naira was very weak, and people in the country, in Nigeria, are more inclined to take their goods to, say, Niger and so on and so forth for sale. So with this, I think the food inflation will come down. I really think that if we check the food inflation in the next 1 or 2 months, I see it coming down to less than 30%, even about 25%.
And I'll get to that conversation in just a moment, because there is also a statement from, I think it's the IMF in that regard, and we'll discuss that in just a moment. But Dr. Mera, I'm also this question is also for you. In terms, because you mentioned the cost of items, and there are divergent opinions in that regard. Some people think that, look, the government should go in there, intervene and fix prices for some commodities. There is even a court judgment in that regard. But some people say, look, the prices of commodities is not something that government can regulate. What do you think that, government, or is there something that the government can do to ensure that the gains also have impact on a day-to-day cost of items in the market?
Yes, well, you know that sometimes in our great country called Nigeria, people tend to take advantage of situations. For instance, when all this, when the Naira was very weak against the dollar, everybody started increasing their prices. And now, and their excuse is that the dollar is high, so cost of doing business is high. Now that the Naira has gained tremendously against the dollar, you still see that some of the prices haven't come down. I suspect that it will start coming down when market forces start getting into play. But for now, it might not be a very bad idea for the government to temporarily impose some kind of price regulations to get things stable.
Mr. Emmanuel, also speak to this price fixing and commodity prices intervention. Is that something that the government should do?
I don't think the government needs to focus on price fixing in terms of in the retail market. I think if the government wants to use FCCPC to focus on price fixing, it needs to focus on what we call oligopolies, and how those institutional, collusion impacts on the retail market. The crux of price fixing is not on the retail market. The crux of price fixing is on the institutional side of it. But more importantly, economics is demand and supply. It's basic. If supply is higher than demand, prices come down. Demand is higher than supply, prices go up. So we need to focus on supply side economics here. I think it's important for us to pay attention to the structural buffers and not the outcome. Pay attention to the costs and not the effects. And that's the challenge we have. I talked about energy and I talked about food. Energy, Nigeria has 9 items that forms its energy basket, and it consumes about $2.4 billion in FX on a monthly basis. Now, if you can backwardly integrate, now you have Dangote. Dangote can produce transportation and non-transportation fuels from your Jet A1 to your automotive turbine kerosene, ATK for planes, to your PMS, to your AGO, to your petroleum coke, asphalt, bitumen binders, and so on and so forth. The crux is in supplying Dangote with the crude oil feedstock it needs to go from, 25% to 50% to 100% capacity utilization in his license to operate LTO that was given to him by NMDPRA, so that he doesn't have to import crude oil, because importing crude oil is additional cost. His refinery is 650,000 barrels of crude oil. NNPC's share in that PSC and JOA currently, less FSAs, is not up to half of that amount on a daily basis. So how can the government ensure? I saw the circular where the government says, it's going to go back to the domestic crude oil supply obligations where, the companies upstream, national oil companies and IOCs are obligated to supply domestic refiners. But the question I have for the government is, where are the spots? There are forwards already for both NNPC in terms of debts they owe and the IOCs and NOCs. Where are the spots? Spots are like feedstock that is not encumbered by already signed agreements to ensure that you're able to meet up with these domestic crude oil supply obligations. If you can supply Dangote with crude oil, you're going to have more of what he's doing, which is crash the price of diesel to 1,000 naira per liter. If you can supply him crude oil, you ensure that he doesn't have to import crude oil into Nigeria. Now, if you can focus on the BOFAs that drives food supply and production, you ensure that the prices of commodities go down. You don't need to focus on outcome by having FCCPC go to fight retailers on price or no price. It's transfer pricing. It's economics. It's demand and supply. If some people in the competition ring reduce their price, everybody will be forced to reduce their price. This is the way the market works. So there's no need for the government to expend energy by sending the agency to go and fight retailers and supermarkets because their price is above what it was 3 or 6 months ago. It's demand and supply economics.